much regained lost ground. It's back to pre-exit poll result kind of levels. Where do we go from here? Especially the pocket that has seen a lot of carnage. There is a lot of curiosity about where that segment of the market is going to go, the PSU stocks. And I have a guest who championed this whole idea of investing in PSUs and showed some kind of faith and patience to make huge amount of money in this segment. Prashant Jain. Prashant, thank you so much for your time this morning. Such a pleasure to have you.
Oh, Mahalakshmi, my pleasure, and a very good morning to you and all your viewers.
So, Prashant, before we get into stocks and sectors and PSUs, what is your sense of where we are in terms of market? Has it completely shrugged off the change that is about to happen politically? The election verdict, has a bottom been formed, or this is just a quick bounce back to the sharp correction we saw on election day, on the counting day?
No, actually, kids are always hard to forecast, like the toss of a coin near term. So with that, in a way, a disclaimer, I feel as the markets went into elections, there was a view which I gathered by talking to people that most participants were expecting a rally post the election results. So I guess the positioning was a little heavy, and the exit polls in a way encouraged that view. And that's why when the results were not up to expectations, we saw a sharp sell-off. I think we need to differentiate between, you said, change in politics. I don't think much is going to change. Of course, it's a coalition government, but with a very large, dominant, close to majority seats by BJP. So there could be some give and take, some here and there, but I think broadly the direction of the economy, the policy making should remain same. So I think that should give us a lot of comfort. And my guess is that I think we should not go back and test those levels unless something unexpected happens.
And what could that be? What could be the unexpected?
No, actually, unexpected can be anything. It can be within India, outside India, some unexpected last minute challenges in formation of this government. I don't think so. All the NDA constituents have reaffirmed their support, and which is the normal thing to do and to expect, or something unexpected, terrible happens outside India. These events are extremely hard to forecast.
Right. Prashant, one question. I think as we speak, one of the things that the market is worried about, and a lot of investors, fund managers are talking about, is a possibility of a fiscal slippage in case, the government has to assure something in this coalition to Andhra or to Bihar, etc. First of all, what do you see as a probability of something like this happening? And second, what kind of fiscal slippage could happen, like I asked, and how would the market react to something like this?
Yeah, neither an economist nor an astrologer, so I really don't know. I feel comforted by the fact that India's growth is extremely good. Revenues are growing at a very significant pace, and government has multiple options to raise resources. So even assuming that you have to spend a little extra somewhere, I don't think it needs to lead to higher fiscal deficit. You have so many levers. RBI gave you an excess dividend, right? The worth of the PSUs is known to everyone. So I think, and the tax buoyancy is there, you are growing at 8%. So I don't think I would worry about meaningful fiscal slippage, even if you have to spend a little money here or there. See, it is the government's intent which is very important when it comes to fiscal discipline. And government is extremely powerful, extremely resourceful. And if they want to prioritize fiscal discipline, I think it gives them enough flexibility to tweak things here or there.
Right. And the second thing, Prashant, the market seems to be worried about, at least the people I speak to, is, could there be some kind of reversal in some policies or some reform measures not passing through? Is there anything specific that you think is at high risk of reversal, or is this a concern at all from your perspective?
See, again, the good thing in India is that in last 30 years, we have seen multiple coalition governments of from all political parties, right? But we have not seen a reversal of the good work done by the previous governments, even when the government changed. So I think reversal of policy direction is very unlikely. It is the same leadership, it is the same political party which is at power in any case. So I would not expect any. And see, the second thing is that bulk of the corporate facing, the business facing reforms are behind us. So if you ask a business leader, a corporate leader, what is it that you would aspire for? I think they would not have any meaningful things, meaty things to say, other than that demand could be little better, things like that.
Right.
The IBC is behind you, GST is behind you, RERA is behind you, PLI is behind you. So I think bulk of the corporate facing reforms are behind us. And it is in no one's interest to reverse this because ultimately you need to create jobs. And this is the most conducive environment that India has for creating jobs, both in manufacturing and in services. So our capex is picking up, GDP growth is accelerating. So I think, and see, there is some people are saying that the seats have been less in rural areas. So I am again not an expert, but I find that in certain rural-oriented states, the outcome has been very good. What about Chhattisgarh? What about MP? What about Orissa? These are also low-income states. These are predominantly rural states. I think there are many factors that go into the outcome of elections. That could be state level, caste level, language level, candidate selection, many things. And I think it's a very simplistic argument to say that the rural areas have not been supportive. And even if you have to do something extra for a certain section of the vulnerable society, I think it can be managed because resources are there plenty with the government.
Fair enough. Okay, one aspect I want you to talk about is power, because you understand power like no one else in the business. Is there any threat of the policy changes that have come by, which is also set the foundation for power stocks in a sense, right? Is there any possibility of retreating from that?
I'll tell you a secret, there are many more who understand power more than me, but they did not believe in it as much as I did. So
first, if we can just start with, for the benefit of our viewers, because a lot of people may have latched on to these stocks, but they don't know the real underlying that created this idea to explode in the manner it has, especially in the stock markets. So what were the big changes that altered this landscape? Where are we now, and could we retreat?
Yes, India's per capita income grows. Power consumption will grow faster. So that is a very basic premise. Our power consumption is extremely low. As you have more disposable incomes, you will put on more air conditioners, and manufacturing is power intensive, EVs are power intensive. So I think the prosperity of a society also is measured in terms of energy consumption. So I think energy consumption in India will grow at a pretty decent pace. And it is well known to everyone that last 10 years, we have not created new capacity, or we have created very small amounts of capacity. And when you put up renewable, solar or wind, the PLFs are in 20s or 30s. So the capex intensity for the same amount of power is multiple times of a thermal. So I think this sector is going to see huge investments because of growth, because of the shift towards RE, and because of the lack of investment last 10 years. And this sector was deeply undervalued to start off with for a variety of reasons which I thought were wrong. One was the concerns around PSUs, the second was the concerns around fossil power and ESG. And I think all of that has corrected itself. And world over, you can see the exclusion-based investing, which had gained in popularity, has lost its way. And I think this is what I had written about in July 22 when I moved out of HDFC, my views on ESG, why this was not pragmatic. In any case, whether you put up a thermal plant or a solar or a wind plant, the key input is capital. So any company that borrows at the cheapest rates, it has a right to win in that marketplace. And therefore the right to win of PSUs in this space in RE is also as much as in thermal. So I think it was a re-rating of PSUs. It was the concerns around ESG getting diluted in India, world over. And then of course, you know what happens in markets always, that when something keeps on doing well, more and more people start believing in it. They start believing in the narrative, and then things can go, the pendulum can swing in the other directions.
So in these past few days, as some of these, you had quite a bunch of those stocks as your top holdings, REC, PFC, Power Grid, NTPC, all of these names, and these have seen some of the sharpest falls, right, on the counting day. Are you out of them? Were you the one causing the fall?
Mahalakshmi, we are insignificant player. We are very, very small. So clearly we cannot influence any market prices. And India is a 4 trillion market. We are insignificant part of it. But see, we focus on valuations and we focus on risk reward. And yes, I mean, in between we saw the prices were leaving, not a disproportionate upside. And that's why it was not prudent to run very large positions on those, and we took appropriate steps. And the subsequent fall, I think, provided it was a very sharp fall. It was unwarranted to my mind. And therefore, again, these stocks were offering reasonable attractiveness. Because, see, the fall was just too sharp, and I don't think anything had changed in that space.
Okay. How do you find valuations in this pocket now?
I think, Mahalakshmi, these are, I would say, now reasonably valued. They are growing businesses, and that is what we have been saying in our commentaries, presentations last quarter or so, that there are no low-hanging fruits. There is no significant mispricing in this market. It was there in defense, in power, in NBFCs, in certain banks. I think that has corrected. And I would expect less dispersion in market returns across sectors in this market. And that's why we have written it that in this market makes sense to run a more diversified portfolio. So we would run fairly balanced portfolios in these markets until such time pockets of great excesses, either over or under valuation, emerge. I think this sector still offers you growth over time because earnings will continue to grow, and the sector also pays out reasonable dividends. So you can add some dividend yields to that.
Sure. Overall, what is your view on the PSU pack, Prashant? Because obviously after this, I mean, they were the ones which also saw the sharpest rise in the last 3 months and 6 months because I mean, they were called the Modi stocks, and they were the bet on the policy shift, etc. And they were also at the receiving end on counting day. What's your take on the entire pack? Will this year belong to PSUs as well?
What I've experienced, Mahalakshmi, is that when something goes up vertically, the corrections are not time correction. There is some price correction at some point of time. If you look at any trend, even whether it was IT in 90s, in that very strong uptrend, there were periodic sharp corrections. So I would say this was one such correction, and I feel these are good businesses, and we should now start differentiating PSUs across sectors, because a PSU bank is different from a utility, is different from a oil company, is different from a defense company. The good thing is that markets are pricing them differently, and I think that's the right way to do it. So over time, I think even in PSUs, you will find different degrees of performance in the stock markets based on underlying fundamentals. I think we should start approaching them as standalone businesses on individual merits.
True that, and I think part of that is already visible in the market, the way they are valuing them. So within the PSU basket, if you were to categorize things that you like versus those that you are bearish on, can you classify it like that for us?
So Mahalakshmi, we like large banks. Let me cover the entire gamut with you.
Yeah.
So we like large banks. They have underperformed both, and valuations are reasonable, balance sheets are extremely healthy. So I think that is a good space. We like consumer discretionary, that should grow faster than consumer staples.
No, so you're talking about the entire market, not just the PSU space then. Consumer discretionary, I can't think
Yes,
of.
let me cover the entire thing, and
Okay.
that I'll cover PSUs also.
Okay.
We are also overweight capex, because I think India is on the world in the early cycles of a long cycle of robust capex growth. Valuations are very demanding in that space, so one has to be very careful. Even we struggle to find value despite the strong growth prospects. We are also overweight the power sector, the power NBFCs, the PSU NBFCs. Growth is there, valuations are reasonable. We are underweight consumer staples, we are underweight a little bit on IT, we are underweight defense, even though it has a lot of promise in terms of growth. I think the multiples don't give comfort to me. I could be wrong, but based on risk reward, whatever assessment we think, we will stay away from it. Oil companies, again, we don't own them. I think banks would probably be better. That's why we are underweight metals and cements, because there is uncertainty in metals and valuations are not too exciting in cement. So I think that covers PSUs also for you. I have covered power, NBFC, oil, NBFCs and banks. Yes.
Right. So, so let's take one by one. So within financials, you said financials you are overweight, right? Like you are overweight large banks. What do you like in this space? Would you prefer banks like HDFC, Kotak Bank, which are totally beaten down valuations compared to the past for sure, or the public sector kinds? You know, you've held SBI in the past. I think you still hold it. What is your preference?
Well, actually, our preference is for strong banks and valuations. So you remember I used to own only SBI, ICICI, Axis few years back, and now that narrative has played out. Valuations have converged. So I think the top 4 or 5 banks in the country that have a good digital platform that continue to gain market share, we own all 4 or 5 of them. My preference is not for the smaller banks. There could be trades out there, but I think on a secular basis, it is I prefer the larger banks to those.
Right. So 2 sectors, Prashant, you said you were underweight on are FMCG and IT. And actually, after day before yesterday, a lot of people have started talking about, FMCG making a comeback because of this whole idea that, consumption might get a boost in the coming budget. So there could be rural recovery. So let's look at plays on that. Even IT, and people also talk about these tech sectors when there is overall uncertainty and volatility, and people think that these are defensive plays. Does this narrative change anything for you at all?
See, I think you have to approach it both from the narrative perspective and from a stock market positioning perspective. So as you go into this cycle, these sectors had underperformed. So probably they were under-owned and the speculative or whatever short-term positions are a lot less than in the other sectors which were doing extremely well. On top of that, these sectors are less volatile, and we have seen even the price corrections are quite shallow. And of course, this narrative was there that because of what has happened, more spending, more rural. I think there could be some merit in it, but I find a greater correlation between penetration of a consumer good and the potential growth rate. So, and even the voting pattern does not, I'm not an expert, but as I mentioned, in many rural, lower income states, you have done extremely well. And even if people get a little more money, I doubt if they will buy more of the products which are necessities and which they are in any case using to the extent they want. If you give up low income people a little more money, it would probably go for more discretionary things. So I would I am not in favor of buying consumer stable companies, and I would still buy consumer discretionary or investment led sectors.
Okay, and within discretionary, again, another question on consumer is, the market overall in the last 1 or 2 years, anybody who has played the consumption theme has latched on to this, premiumization trend, because that is where spending was really going, and companies were also tweaking the strategy to ensure that they ride that. Now, again, you are questioning the whole idea that, rural has been the factor that has resulted in the poll outcome that we are seeing now. But park that aside for a minute. Do you think in the next 1 year, mass market consumption themes will do better than premiumization? Could there be a shift?
It's very hard to say, Mahalakshmi. And see, I think people like me are always looking for, we are thinking 3-5 years. 2, we are trying to look for risk rewards. See, premiumization is there, but we cannot ignore the fact that some of these companies are sitting on lifetime high margins, unprecedented margins. And even if you look at the global counterparts of the same companies in other geographies, these margins have not held for long periods of time. So if you sit on very high margins, competition will come. And in any case, even in the best of times, these companies have delivered a high single-digit growth rates. And through pricing power, the margins have gone up 5 to 10%. So I think in any case, this was not a high volume growth sector, and I don't think that is going to change. Premiumization is a very slow, gradual, long-term trend, and it is there in your even numbers for last 10 years. So I would say, on the other hand, you are experiencing new longer-term challenges like D2C brands, like private labels, like distribution being organized,
right,
like e-commerce, aggregation of. So I think these are also, and from a stock market's perspective, almost every other sector should grow at the same rate or higher rates in terms of profit growth, and the multiples are a lot lower. So I would say, while premiumization will continue, it is clearly visible in cars, in two-wheelers, it is visible. So, but for consumer staples, I don't think the trajectory is going to change because of what has happened. If at all, margins could be at risk, and there are some indications that pricing is at risk because you are losing share, so you need to cut pricing in certain categories. And over time, the consumer has become aware. So, because of either peer reviews, general higher level of awareness, I think maybe the consumer is also willing to try new brands which are coming from established business houses, private labels, etc. So I think the extent of pricing power which was there with this sector in the past may moderate to some extent also.
Sure. What about IT? IT again, you said you're underweight. Do you think you're underweight because you don't think growth rates will revive and the risks of US recession have not gone away, or is there any other reason?
Well, maybe I see. We have, to be honest, we have cut our underweight because the sector has considerably underperformed, and others have done well. So it is not as expensive on a relative and absolute basis as it was some time back. The question is of growth. I don't think we have a clear view what is the likely growth, but we do feel that if the growth rates improve, then the sector could outperform. And that's why, to hedge our bets, we are running a very small underweight now. This is a high quality business. Payout ratios are extremely good. Dividend yields are reasonable. Though I also feel at the same time there are headwinds of higher wage inflation than rupee depreciation because India's current account deficit is quite low, and there are many claimants for the same people. The GCCs are a force to reckon with when it comes to hiring talent.
Right. Prashant, another point is that, people also argue that, now all of us have to reset our expectations, of course, for returns. That's another story. But that there has to be a reset in terms of how we think about valuations, because there is so much money. At one time, we used to rely only on foreign money to come and, make large purchases. But now you have SIP book of 20,000 crores that is, that's almost like guaranteed to the markets every month. In this scenario, everything, at least in the last few years, every dip has been bought into, including this one. So how do you, have you sort of raised the threshold for valuations yourself?
So Mahalakshmi, I think we have written about it in very, very simple words that why India deserves to trade at higher multiples compared to the past, but for different reasons. See, it is true that local flow of savings to equities is quite structured and pretty sizable, but at the same time, so is the supply of new stock. So if there is a SIP book for inflows, there is also a constant flow of issues. Ps are selling, promoters could be selling down, and virtually we are probably raising 3 lakh crores a year by way of new supply to the market also. So I don't think you can justify higher multiples in perpetuity just because there is more demand for equities. I think the reasons why we feel multiples are okay, even though they are higher than the past, is because of 3 reasons. One, India's growth rates are accelerating. We have grown 5 to 6% for 2 decades. We are now growing 7%. And this is what we've been saying for 1 year, that India's growth rates will reset themselves higher. So that is the key reason for higher multiples. The second is cost of capital has moved lower. The gap between Indian and US interest rates, it used to be 4 to 6%, is now running 2.5%. That is the second reason why your fair multiples should be higher. And the third reason is, which is partly linked to what you said, is that the flow of local savings to equities has reduced the foreign inflow outflow led volatility of Indian markets. Therefore, I think as volatility heads lower, you can justify slightly higher multiples based on that account as well. So I would say what you said is one of the reasons, but the other two are probably a little more important as well.
Is there any risk to this growth, Prashant? Because it's not that, every time we are at an elevated level, there is always this tendency to project it into the future. We saw this in 2007-8, and we really, people got deluded into thinking that 7 to 8% growth was a given for India. We were targeting 10%. This time around, is it very clear to you that a new trend has been established?
I think while the growth numbers are same, the context is very different. Those growth rates were achieved of 7% in the last stages of a capex cycle. Corporate leverage was peaking around those times, and our regulatory framework was a lot less mature. There were too many disputes, too many areas in which private capital had ventured into for the first time in the country, whether it was roads, it was airports, it was power or telecom, and there were disputes. But today we are achieving that 8% growth in the early stages of a capex cycle, and bank NPAs are close to zero, when corporate leverage is at a 10-year low, and there is regulatory framework is far more robust, and the external environment is far more conducive to offshoring of both manufacturing and services. Therefore, I would expect this time these growth rates are on a far firmer footing compared to what we experienced pre-legal.
Fair enough. One last question on financials, Prashant. There is this feeling that RBI is becoming very aggressive, in regulating, and from the largest bank and the banks that were perceived to be very high quality, you've seen action against most of them, whether it is HDFC Bank or a Kotak Bank or Bajaj Finance. These were like names, these were like poster boys of high quality, right? Do you see this impacting investor sentiment and creating some kind of a negative impact on these stocks and put a cap to valuations in financials?
I would say quite the contrary. If the regulator is so alert, so good, so agile, it will reduce the risk of bigger mishaps in the future. So it should give one more comfort that the system is extremely robust and well regulated. However, I do feel that the previous multiples enjoyed by this sector are unlikely to be seen again, and that is because the capital adequacy names have ratios have moved up, norms have moved up, and because of that, your sustainable ROEs have probably settled a bit lower. Second, in those times, many banks were struggling, those corporate facing banks. Today, most banks are extremely healthy. So there is intense competition in every single space in the marketplace. And third, I think as India has moved to a low inflation environment, your growth in business itself, growth rates may reset a bit lower. I think it is because of these 2-3 reasons. And also, see, the pace of market share gains has slowed down significantly. And that again will limit your growth premium. So I would be comfortable if these were to trade somewhat higher in terms of ratios, but I would not expect them to go back to the valuations that were being enjoyed 5-7 years back.
Right. So how much more scope do you see for valuations to go up? Today, as we speak, even a HDFC Bank and a Kotak Bank trade at 2.5, not even 2.5, 2.2 times book value. Could it become 4, 3? What is the cap?
I think they are trading around 2, slightly under 2 times fiscal 26, which is what I am focusing on right now. I think it could go to 2.5, 2.8, maybe 3 times. That is what I would be comfortable. I don't think there would be upside to that. I would be more comfortable maybe 2.5 odd times.
Okay. So that's all from me. Thank you so much, Prashant. Such a pleasure talking to you this morning.
My pleasure, Mahalakshmi. Thank you.
Thank you.